There's a moment in every venture capitalist's career where they sit across from a founder and feel it, that deep gut certainty that this person has it. They're just 3 minutes into the meeting and they already know. This feeling, folk knowledge tells us, is what separates great VCs from good ones. This embodied capability to pattern match at speed, to trust your instincts, to feel the future in your bones. Except, what if this feeling is wrong? What if this automatic, effortless certainty is just your brain taking shortcuts, favoring people who sound like people we've already backed, who present ideas in ways we're already primed to receive? What if an entire industry has over-indexed into a feeling that means they miss some of the best opportunities on the table? This is what today's guest wants to convince you of. I'm Jonathan O'Brien, the editor-in-chief of Inflection Points, and welcome to the Inflection Points podcast. Today, we're joined by Jessy Wu, who spent 4 years on the inside of Australian venture capital, first at NAB Ventures and then as a partner at AfterWork Ventures. She was part of a team that deployed $20 million into 30 companies, building a community-powered model that challenged how VC traditionally works. And then she left. Not for another fund, not for a bigger partnership, but to build the kind of company that would never be in the mandate for a VC fund, a professional services company in the AI era. Because after years of evaluating whether founders were pursuing their life's work, she realized she wasn't pursuing hers. What follows is a conversation about cognitive bias dressed up as intuition, about the $2 trillion professional services market that VCs typically ignore, about what it costs to speak truth in an industry built on relationships, and about why democratizing venture capital isn't charity, it's the key to the next generation of Australian innovation. Ladies and gentlemen, here is Jessy Wu. Jessy Wu, welcome to the podcast.
Thanks for having me.
Australians, I think, don't know a huge amount about venture capital, right? When we think about it as something that happens in San Francisco, maybe London. So give us a lay of the land. What does venture capital look like in Australia?
Yeah, great question. So I think the thesis behind venture capital is that for certain kinds of companies, while a lot of them will fail, there are some where when they succeed in an extremely big way. And if you have the opportunity to invest a check really early in one of these companies and keep investing money as they grow, the return profile of your fund overall can look pretty spectacular, something that is far better than anything you could access in listed equities, in property, in any other thing you could invest in. And I guess the driver of that is the fact that companies, particularly tech companies, once they hit escape velocity, are able to compound their advantage. I'll take a company that is pretty seminal to the growth of venture capital in Australia, which is Canva. I think most of our listeners would be familiar with a graphic design company, easy to use, web-based, started in 2012, and today is worth $40 billion and generating $2 to $3 billion of revenue and continuing to grow. Now, that was a company that was invested in 3 funds when they were just starting, and those 3 funds are some of the largest venture for capital funds that exist today. So that's Blackbird, Square Peg, and Airtree. Blackbird in particular, out of their first ever $29 million fund that they raised in 2012, invested, I think, $2 to $3 million in Canva's seed round when the valuation was maybe $20 to $30 million. And they now, through investing time and time again in subsequent rounds, buying secondaries from early investors who wanted to exit, own, I think, 12 to 15% of Canva. Now at $40 billion, that holding is, worth well over $4 billion. So they're sitting on a splendid return. Their early fund will be one of the best VC funds that has ever existed. I think it's already sitting on a 60%, not 60%, a 60x return to investors in those funds. And the funds that came subsequently that also got exposure to Canva are top decile funds globally as well. So I guess to bring it together, the driver of venture capital is there's an asymmetry in the downside versus the upside. The downside is capped. The worst thing that can happen to a company is it goes to zero and you lose the amount you invested, but the upside offsets that so disproportionately that if you manage to just hit one generational winner, such as, Canva or Airwallex or Rocked. And then there have been some smaller outcomes such as, Go One, Safety Culture. Then you are sitting on a fund that has a much better return profile than something like listed equities. Albeit there was a chance that everything in that fund failed, or there was some kind of, black swan event that wiped out the whole market and it all goes to zero. So that is why venture capital is attractive and why, it is sound for somebody who's thinking of constructing a portfolio with diversified exposure to different risk categories to allocate a proportion of their wealth to venture capital.
Yeah, so that Canva outcome, that sort of defining moment of Australian venture capital, that really underpins, I suppose, part of your thesis, which is that venture capital has become very centralized, right? How much of an explainer is that Canva story?
I think that, the fund returns of the funds that manage to invest in Canva are all globally top decile. Certainly Blackbird's 2012 fund, that $30 million fund, will be one of the most successful VC funds, I think, in history because they put $2 million or $3 million of that fund into Canva. So, superannuation funds, for example, invest based on track record and the return profile from those past funds. They kind of see it as a marker that past success represents future success. And we can talk about whether that's the case. I think it sometimes is, sometimes isn't. So I think the ability to be like, look, we have a fund that's returned 60 times or 19 times or, 8 times, definitely lubricates getting more institutional capital. And I think it is a contributor to why those VC funds have been able to raise large amounts of money from Australian institutional funds and then international funds as well. And then it's also the way in which that advantage, like that brand advantage, compounds, right? Because, when you say, oh, you'd be in the company of a company like Canva and others that they invested in, that's really attractive to founders coming through. So, when you get a bit of a head start because you managed to invest in such a winner, it really puts you on a virtuous cycle.
Right, because you end up with a lot of brand equity via the brands that you have equity in, as it were.
Yeah.
I want to hear the case. Obviously, superannuation is part of this, right? Every Australian just about has some amount of money tied up in superannuation that they have a stake in. It gives every Australian, whether they're aware of it or not, a large stake in kind of the progress of these companies and companies in Australia generally and the world generally too. So every Australian has skin in the game. But when people hear about venture capital, and I think often rightfully so, they often feel like they're hearing about a large amount of money that's going to a small number of people, right? Or controlled by a small number of people. I want to hear the case for venture capital as a part of Australia's future. What is the case for kind of indexing into good policy for more venture capital?
Yeah, so I think, Australia, and you've written about this across a few articles, Inflection Points, is really struggling with a few things at the moment. It's struggling with the complexity of our economy. We really lag other advanced economies or middle powers when it comes to, the amount of our economy that's driven by advanced manufacturing or high-tech things. A lot of it still comes from, either domestic services, which is perfectly fine, or mining and those kinds of exports. And I think as, we run out of things to dig out of the ground, albeit we can find new things, new kinds of things like, lithium, uranium, etc. But as I think revenue from coal probably diminishes, iron ore probably will diminish as, say, China is through that huge construction boom. We need to find other ways to kind of fill the hole in our GDP that leads to. And I guess the whole world is moving towards tech, right? Andreessen famously predicted, and it was very prescient at the time, that software is eating the world. As kind of more of the economy is driven by software, I think it's really important for Australia to get some kind of exposure to that and build some sovereign capability, which is Australian tech companies that can either be the suppliers of our own kind of tech economy, or, ideally can export that to the rest of the world as well. And tech companies are the kinds of companies that are often, like a portion of tech companies, are quite well suited to venture capital. Why is that? Because they're cash hungry in the beginning. They require some kind of upfront investment to build the product. That being said, AI is reducing the cost of building product. So I think we'll see some shifting dynamics there. But, in this kind of AI era, maybe the impetus is that we need to build like proprietary AI models, foundation models, and that will require capital upfront. So anyway, they're the kind of company that traditionally requires a capital injection upfront, needs to lose some money hand over fist in order to acquire customers. The first enterprise customer that you acquire, whether that be a bank or a large telco, is probably not going to want to pay a full rack rate. They're going to use their negotiating power to get you to run a pilot for them pretty much for free.
When you say rack rate for our
yeah,
listeners.
sure, is not going to pay, the kind of target pricing. They're going to ask for a really steep discount for taking the risk on using your product early and giving you that kind of lighthouse signal. So these companies need to lose money hand over fist to scale. They need to, win the war on talent, get the best engineers, build a really great product, build a great sales team. But then once they've captured a certain amount of the market and they are seen as, a credible, reliable supplier of, let's say, software to a big enterprise capable of handling, thousands of seats and demand and steady enough to support government use cases and things like that, then they're kind of off to the races. They lock themselves into these enterprise contracts that they can expect to last for 3-5 years. They can increase their pricing, they can increase their margin, and, quite quickly in year, 5, 6, 7, they start to grow revenue really quickly. And they've built an engine where the more salespeople they add, the more engineers they add, they can make that product even better and really start to compound their advantage. And you often see the extent of winners be realized in those last 8 to 10 years when they've truly hit escape velocity and their market dominance just compounds. So I think those are the kinds of companies. So I guess, in Australia, it probably is Atlassian, it's Afterpay, it's Canva. There's a cohort coming through such as Eucalyptus, which is a different kind of company. They're a consumer brand, but they are compounding their advantage. Things like Safety Culture, Go One Rocked. They are off to the races. They've hit that escape velocity. They're providing a huge number of tech jobs in Australia. They are, headquartered in Australia. So they are the drivers of, I guess, the future economy. They've trained a cohort of people who have engineering skills, enterprise sales skills. And that is a really important part of diversifying our economic mix and making it more complex.
Yeah. One of the things that has really allowed software companies to scale in a way that venture capital likes is that the marginal cost of the additional customer or the sale of the additional product is like as close to zero as possible, right? There's not sort of the fixed cost on, say, this t-shirt and the customer acquisition. So that's been really advantageous in the past. One way that AI really disrupts that is that the operational expenses are much higher now.
Yes.
Which, even though there's kind of the promise of tech style scaling, the costs are much higher to provide AI style products. Does that change the calculus in the long to medium for venture capital?
Yeah, I think it does. And I think it's something that venture capitalists are having to grapple with. I think traditionally SaaS companies, the target gross margin would be 80 to 90%. The only real costs would be the cost of hosting the server. It depends how you calculate it, but that's pretty much the marginal cost. Whereas now the marginal cost is the cost of the compute. So if you are a wrapper around a foundation model provided by OpenAI or Google, then for the workflows that people are running through your product, you have to pay a token cost to that underlying model supplier. And I think that is contracting margins to 30 to 40%. That being said, there's a precedence of companies with margins of 30 to 40% still scaling and becoming large companies. I think airlines have like margins closer to like 10%, or, Woolies has a margin of like 5% or whatever. So it's not to say that these can't become large companies, but certainly the way that they're funded and the path to market dominance, I think will change. So I think the mental model for investors backing these companies needs to change as well.
Yeah. And there's also, I think, how much opportunity is there for the investor model to change, and how much is it just tied up in this sort of AI optimism that this thing is going to scale down, that this is going to become affordable like traditional software?
I mean, certainly in Silicon Valley, what I hear is people are just like, whoever gets to AGI first will get a slice of the light cone of the universe. So it doesn't matter. If you think OpenAI has a shot on goal, if you think Anthropic has a shot on goal, Meta has a shot on goal, they will just, whoever gets there first will earn the right to print money forever. So there's a speculative aspect there, right? Where it's not a multiple of revenue or growth. It's just who can build that capability the fastest.
What about for wrapper companies, though?
I mean, I think you've got to believe that, there is a layer of orchestration, product experience, UX, and then the difficulty of an enterprise sale. That means there's a certain right that you earn to extract a certain amount of margin on top of the underlying model, and that OpenAI won't get so good at kind of just forward deploying architects straight into these enterprises to build bespoke things for the Combanks and the Qantases of the world.
But presumably if you have AGI, the AGI will do that, right?
I honestly, I'm not in the industry anymore. I do work adjacent to the industry still, but I do think a lot of VCs are, tossing and turning at night because we've never had such a rapid changing technology that has forced these mental models around who gets to create and capture value as fast. And they've raised these funds, with these marketing materials saying, invest in us if you want exposure to AI. Right. So they have LPs. These are people who invest in funds breathing down their neck saying, I want exposure to AI. Give me AI. And you're seeing, for example, you saw SquarePeg and Airtree invest what I thought was quite an out of mandate investment in Mira Murati's Thinking Machine Labs, a pre-seed company insofar as wasn't particularly defined what they were doing. US company with these OpenAI elites, Mira Murati, John Schulman, Andrew Tulloch, who's an Australian, raised $2 billion on a $10 billion valuation straight out of the gates, pre-product, broader team. And that's quite a specky bet. That's not really how Australian venture capital has historically gone. Historically, it's been a $2 million check on a $10 million valuation if it's at the pitch deck stage to really iterate and prove things out, not a $2 billion round on a $10 billion bet. So everything is changing. And I think venture capital has to evolve, and fund managers are figuring out how they're going to make it work in a new paradigm.
Yeah. So I guess maybe the hardest question I can ask you is that an indication of a bubble? This kind of behavior that's even happening in Australia?
There's a lot of speculation. Is it a bubble? I think that there is probably a really big prize to be captured by the market leader. I think you're already seeing OpenAI bet down a lot of the advantages of being the market leader. Like, I think something was released around the market share for consumer usage that all of these different things have. And I thought it was a lot more even between it, because I think in my circles, as many people use Claude as use ChatGPT. But I think
ChatGPT is more than 50%.
No, it's like nearly 85%.
Yeah.
It's like 85%. Gemini is like Claude is only 2%.
Which is surprising because, a lot of people in my circle also, including, myself, Claude is the model of choice.
Yeah. And then now you're seeing, so OpenAI obviously has huge brand, ChatGPT is almost synonymous with AI for a lot of people, right? A lot of consumers. OpenAI is therefore the Kleenex of AI. And so you're seeing them get into CommBank, right? Big contract. And New Zealand's using them. This isn't well known, but it is on the record. They've gotten into government. So the government is through Gov AI using them for 2 use cases, one procurement rules use case and one ministerial responses use case. So there's a department that's using AI to respond to letters to ministers. They got that in a small tender, I think $50,000 tender that didn't go out very wide. And it was under the tender threshold, so it didn't have to follow a lot of the procurement requirements. But there's an opportunity for them to kind of land and expand within the government. And I'm not saying the Australian government rolled out the red carpet for them, but I think one of the reasons that they were able to get in is because they were synonymous with AI. So to the extent that government wants to be improving their capability using AI, they are like the obvious one to use, right? They were always going to get there ahead of something like Anthropic, which has less brand equity, less knowledge, and certainly something like DeepSeek, which is made by China. So there are lots of reasons why burning money hand over fist just to get to that first will create a lot of value. And you could argue that it's not a bubble because those kinds of companies will just become the most valuable companies in the whole world by orders of magnitude.
Yeah, a lot of the calculus here sort of relies on AI continuing to sort of scale and not hit the peak of an S curve, right? Yeah. Which I think we are yet to see. I'm certainly yet to be convinced on it, and I'm sure some listeners will reach out and say, "Oh, I can convince you." Let's move over to your Inflection Points article and the dilemma of Australian innovation overall. We've talked a fair bit about VC as it is. Give us an overview of your thesis. What does diversifying Australian risk capital, the title of your article, what does that look like?
Yeah. So I think what I mean by that is normally when people want to increase innovation in Australia, they simply call for more investment, and they call specifically for the government to invest either directly through a model like Breakthrough Victoria, where Victoria had a $2 billion fund that was allocated both to fund investments and direct investments, particularly in deep tech companies, or they call for like a government-funded fund of funds, so the government investing directly into small venture capital funds. And I guess it's kind of like do that, ... a kind
Profit.
of burst of unicorns. And I think my thesis is that there is already a large amount of money available via the big funds. So that would be Blackbird, Squarepeg, Airtree. There's a few others that are nearly there. Main Sequence is a big deep tech fund. One Ventures is a big fund with a focus on health. So my argument is that those funds are well capitalized. Between Blackbird, Squarepeg, and Airtree, just this year, the 3 of them will close around $1.7 billion of new funds to deploy mostly into Australian startups. So for the companies that fit their mandates, there's enough cash there. And what are the companies that meet those mandates? It's companies that we've been describing in the first half of the podcast, cash hungry companies that can digest, $5 million initially, but then $100 million over the course of 5 years, and deploy that money to gain a market advantage, normally in a global market where it's a winner-take-most dynamic, such that in years 8 to 10, they will make lots of high margin revenue and continue to scale. And that's great to have in Australia's economic mix. As we described, these are real engines for tech innovation. They create jobs. They put us on a global stage. If they list in Australia, which not a lot of them will, but the ones that list to Australia will give Australian retail investors and superannuants exposure to tech. That's all fantastic. But there are lots of companies that are also good to have in Australia's economy that also diversify our mix, that don't fit that global from day one, winner take most ability to scale to, $1 billion of terminal value within a 10-year period. That is a kind of almost pathological extreme. And I think because venture capital is quite good at marketing, there is a sense that those kinds of companies are synonymous with tech startups, that every tech startup has to match that mold. Whereas I think there are lots of companies that are on much surer foundations if they're more clear-eyed and realistic, if you will, about what they're trying to achieve, such as over 10 years scale to 20 to 50 million of revenue, not necessarily 80 to 90% margins, and do so in a kind of capital efficient manner where you have a pretty close eye on profitability at all times, and where you're not trying to gain market dominance, you're trying to build a business with good unit economics. So these are, niche software companies for specific industries, lending companies, companies with a hardware component such as manufacturing, companies that are like consumer brand companies, right? Lower margins. And I think because these companies, you really have to squint to see how they can become these global unicorns. They are not the right fit for those funds to back. And sometimes when those large funds back them, they are entertaining a degree of cognitive dissonance to think that it's exactly the same kind of company as a Canva, right? And so I think that in order for there to be honest investments in these kinds of companies, we've got to change the mix of risk capital that's available. So we have funds that are the right size, set up with the right kind of employees, promising the right kind of risk return profile to their underlying investors to back these other kinds of companies.
Great. You're not naive. In the article, you roughly ask up front, if there's genuine opportunity to invest in these overlooked businesses, why isn't anyone capitalizing on it? My economist friends will say, well, there aren't $100 bills lying on the ground. What's being left on the table by current venture capital and why?
Yeah. So my thesis, and I think it's one developed from the experience of being the manager of a small fund. We raised just under $20 million in our first innings. And because of our fund size, we were able to make some different kinds of investments to the ones that were in the sweet spot of those large funds. But then there's described as a kind of chasm when it comes from trying to scale from that $20 million fund to your next fund, a $30 to $50 million fund. And I think that is one of the bottlenecks to why there are these $100 bills on the ground that no fund is kind of able to on-ramp to picking up. So, could you imagine a fund that said, we are going to raise a $20 million fund and we're going to really focus on investing in consumer brands, maybe that aren't just drop shipping, so they are making the product in a kind of proprietary way. They are, they have excellence when it comes to operational control, cost control, inventory, marketing, all of that. Ambitious founders who run a really tight ship, and some kind of product differentiation. But we are really happy with 40% margins, and we don't expect them to be global from day one, certainly, because then they would be trying to build factories all over the world and supply chains all over the world. But we think that investing, $2 million once they've kind of got their early set of customers is a really nice risk-adjusted way to get to let's say $500 million terminal value outcome, being a real market leader of a certain niche product in Australia.
So this requires kind of a change in the expectations of venture capitalists, right, to run these kind of funds, because we're not thinking about these terminal velocity companies. We're thinking about a smaller return in terms of what we would expect from venture capital more generally. So you're almost asking for not more conservative, but more measured venture capital, maybe a larger number of more measured firms.
I think a larger number of firms that are basically offering different investment products, like different risk return profiles, where they are smaller funds able to generate that 3 to 4x risk adjusted return profile that some LPs are looking for, where they are saying we're not going to directly compete with the big three or with international funds. We are going to invest in companies that don't fit their mandate, but have a really nice path to returning, say, 10x with much better downside protection, less likelihood of going to zero.
Yeah, so less likelihood of going to zero, but still some likelihood that you might not get return on your investment. Is there a degree to which this becomes more risky because across a larger number of investments, you might not have that big winner that makes up for a bunch of non-big winners or things that go to zero?
I think that these funds, they probably wouldn't write many checks at pitch deck stage, right? There would be certain kinds of risk that they would say, we're not going to take because we don't have the ability to hit an outlier that might offset all of those zeros. So they might say, we really require you to be doing $1 million of annual revenue. We require for there to be those early signals of product market fit. We might be a little bit more conservative in backing founders who have some kind of subject matter expertise or a few laps around the block. We might not back as many 19-year-olds. And so, yes, there are companies that can still go to zero, but there's more reassurance that it's not going to kind of fail to launch.
Yeah, okay. So what's specific to the Australian context that is kind of stopping these sort of things from happening?
Yeah, I think one of the big things is the kind of set of policies and enabling infrastructure around letting funds who have these kind of different offerings and maybe different insights about where there's alpha to be found to come to market. And some of these things I describe in my article. So one of the things is there's a lot of tax advantages granted to VC funds that are ESVCLP qualified.
Which stands for?
Early Stage Venture Capital Limited Partnership. So the government, and I think this is a really good policy that helps some of the aforementioned funds get off the ground. But they're basically the government saying, if you are invested in this type of thing, we think that's broadly good for the economy. So we are going to give you a tax concession. I think there's a capital tax break, and there's also like an offset that you get for investing in these kinds of funds. But in order to qualify for that, both there's like a pretty lengthy accreditation process, which you need to engage an advisor that has a cost, but also your fund size needs to be $10 million. So it puts the onus on an individual or a group of individuals to come and raise $10 million in Fund 1, which isn't impossible. And we did manage to overcome it as a group of young people. But I think you have to get pretty lucky, and you have to be operating in a bit of like a ebullient time. I think to ask one person to have enough, juice in their network to raise $10 million is a incredibly narrow persona of person. And if you are not an ESVCLP, like you're a $6 million managed investment trust, which is kind of what you have to be if you're not an ESVCLP, and you're going up against an ESVCLP, it's incredibly hard for you to make yourself look as attractive to that ESVCLP, because that tax concessions means that they have to achieve lower kind of net returns in order to deliver the same amount back to LPs. So I guess lowering that threshold to, not something silly like $500,000, but something like $3 million, where, you still got to have enough money that you can actually take shots on goal, but you can have this micro fund that you can use to build a track record before you then go for a larger second fund. I think that would be one of the things that I talk about in my article to create an on-ramp. There's two others that I talk about.
Yeah. There's a few ways of making on-ramps, but I want to kind of zero in maybe on something that people can certainly read your article for the real technicals, right? And maybe zero in a little bit on the cultural stuff, right? You talk about taking shots on goals, risk taking. You've talked about, tall poppy syndrome. We were having breakfast this morning and talking about all this stuff. What do you think there is sort of in Australia that, if policy is downstream of culture or culture is downstream of policy, that's a completely different epistemological debate. But what is there in Australia that kind of makes us maybe take fewer risks than, say, our American counterparts?
So this is like the founders, the tech founders, perhaps taking less risk?
Sure, or just Australians maybe more generally.
Yeah. I mean, I think, some of the things we talked about this morning, I think that Australia, especially compared to the US, does have a very great baseline quality of life that it underwrites for most people. We have pretty generous social protections so that you know that if you have a health scare, that if you don't have health insurance, you're still going to get looked after, right? We have generous provisions for people with disabilities, and for aged care to look after, aging parents. So I think there's not a sense that, in order to ensure the well-being of yourself and your family and those that you care about, you kind of have to make a generational amount of money. We know we're going to be looked after. I would also say, inequality is far less in Australia than it is in the US. So there's probably not the sense that, people really covet something that they see and is out of reach for them. I also think, America does a great job. Silicon Valley does a great job. I mean, they're unwinding this, which is dumb, but of attracting the best all around the world, right? So a huge amount of migration from India, from China, lots of Aussies going to the US as well. They have schemes like the O1 visa. So they've kind of created a bit of a critical mass of really talented individuals benefiting from agglomeration. A lot of my friends are moving to SF to build in AI, and they're saying the amount of capital that's available at the angel level. Lots of people who've exited, maybe gotten an exit from OpenAI secondaries or from Stripe or Coinbase or whatnot. Lots of money that has come through to the generation of operators who rode those highs, FAANG companies as well, just giving out checks, somewhat indiscriminately to people who are having a shot on goal because they know it is one of these, 19 to 25-year-olds who might invent the next best thing. So there's a sense of abundance there. Less kind of scrutiny on the minutiae of how somebody is going to work. A belief that maybe the best people are going to figure it out and figure out the right wave to ride, and you can't even see that wave coming yet. I think there's a sense in Australia of needing to be really, buttoned up with the way that you allocate capital. Perhaps that money has come from, generational wealth who's trying not to lose the money that their predecessors made. So generally, perhaps a sense of conservatism in how those bets are made. And also on the founder level, less kind of a founder pathology around I've got to make this work. And maybe in the kind of operator class, the early employees, a sense that, there's no interest in grinding, in having Sigma grind set 15 hours a day, because, why would you do that when you can go to the beach and to hang out with your friends?
Totally. This is really simpatico with the sort of sister article maybe of yours in
I read that this morning.
in Inflection Points, which is Brandon Shepard's industrial policy for tech workers, which is kind of exactly about this, right? This kind of creating these virtual circles, particularly of angel investors, and allowing a little bit more fluidity of capital within the Australian market so that people don't feel like they have to go to Silicon Valley to build the next big thing, right? And I think I'll have Brandon on the podcast at some point and we'll have a similar conversation. But I want to go to what you kind of just said there, because I think there's an interesting needle threading here. on the one hand, we're talking about Australia needs to take bigger risks. On the other hand, we're talking about our funds are actually attuned to risks that are too large. How do you thread the needle in terms of knowing what a risk is worth taking? And when does something stop being venture capital and just sort of start being sort of a higher growth kind of fund?
Yeah, look, I mean, it's a little bit semantic, right? Sometimes people throw around accusations that it's not real venture if, you are only investing after product market fit, and, you've real venture is looking at someone when they've just got a glint in their eye and, knowing that they'll build the big next thing. I think that, whatever you want to call it, new businesses, disrupting incumbent industries, using kind of the best, not having the tech debt of incumbents that were built when technical stacks were quite different to what they can be now, especially with something like AI, are good for the economy, right? My business, for example, is a services business in many ways. It's a comms agency. Our margins are not 80%, although they can be high, especially if you use AI to say, automate a bunch of repetitive workflows, automate your back office, such as lead qualification or, your accounting and finance and things like that. I think but I observe that, what I'm able to do is I'm able to create quality jobs for ambitious young people. I'm able to offer a service to the tech industry to help them be better at storytelling, at commanding the narrative, at becoming kind of thought leaders in their industry. Those are things that help tech as a sector to grow and to, become culturally impactful in Australia, which is kind of coherent with the theory of change we articulated up front about wanting our economy to become more complex, right? There are lots of these kinds of new fledgling businesses. Some are like mine and don't need upfront capital to get started or need a very small amount that can be footed by an individual, but some need, say $2 million to build some form of proprietary tech, or maybe they're a lending business and so they need an amount of money to do their first 10 loans out of so that they can prove out to a debt facility that they have built a track record where they're not making losses. What's another kind of business? Say you're you have a vision about a new kind of sunglasses, right? That look really cool in a certain way. You need an amount of money to finance your first manufacturing run, which is just something adjacent to like warehouse financing. But with no track record, you're not going to get a bank or some kind of professional lender willing to lend to you. So there are certain kinds of businesses that need a capital injection upfront that are not going to be winner-take-all billion-dollar outcomes, but still really help different parts of the economy and still require somebody with a really strong will and a vision to take a shot on goal and to be able to leave whatever full-time employment that they're in and to have enough money to hire a few people or pay for the upfront costs of getting started. And I think that's what I'm advocating for, that there is currently an illusion or a conflation of entrepreneurial zest and zeal and a vision to start something from nothing and becoming a venture-backed startup founder. And I'm like, there's so much in between. And when you conflate the two, what you really reward is people who are really good at bullshitting that they can create $1 billion business, right? Like, look me, like I just got this glint in my eye. That means I can. And there's probably a degree of bias in terms of who society recognizes as fitting the bill for that. Whereas I just want kind of more honesty in terms of people being really clear-eyed about what they want to build, what they can build because of the product and the business model that they're chasing. And then a funder being able to be clear-eyed to say, yep, I'm happy to fund that, but I'm not going to value your company the way a venture capitalist values a tech company and write you a check for, $2 million at $10 million at a pitch deck stage in exchange for a small fraction of your business. It really has got to be a $1 million check for 30% of your business after you've proven out a few things already. And for the market not to be kind of distorted by people who are just willing to tell kind of tall tales about how much they can feasibly achieve.
That makes a lot of sense. I think that really ties together your kind of thesis there, and I think is a really nice way to land the podcast with our final question, the one we always ask, which is, what's one thing about how Australia works that you think more people should know?
Yeah, I think something that's really interesting about Australia from my perspective. So I'm actually a Kiwi. I grew up in New Zealand. I'm a New Zealand citizen, not an Australian citizen. I could get my Australian citizenship, but I can't be bothered doing the admin. And something that is really interesting and I think quite unique in the world is just the extent of the free trade relationship between Australia and New Zealand and how connected those two economies are, particularly when it comes to the mobility of people. So all New Zealand citizens and vice versa are able to access special category visas to the other country. So as a New Zealand citizen, whenever I, come in, scan my passport, I get given a new special category visa that allows me to work here, like the same working entitlements as Australia, and some of the access to social welfare provisions. I get Medicare. I don't think I get NDIS, or am not eligible for NDIS. I don't think I get Centrelink, but you get a lot of safeties. And as a result, I think over 30% of young people or people below the age of 30 New Zealanders are over here in Australia. And I think it is really beneficial to Australia because New Zealand is a smaller market. So people who are ambitious and want to live in a bigger city, want to challenge themselves in different ways, do end up coming to Australia. And I think, that there are lots of Kiwis working in tech, senior at various tech companies or have founded Australian tech companies. And that is really beneficial to kind of these skilled sectors. So I think it shows that skilled migration can be a real driver of the economy, right? You have this good test case. I don't know exactly how it scales, like if we just increase migration heaps, but I think really targeted skilled migration can do a lot to really buoy a sector like tech. And I think that's something that Brandon talks about in his article.
Yeah, it's a case Brandon's made, and Brendan Coates also put forward kind of the migration reforms in the Moving the Needle article, also available and recording as well. Our first podcast episode was a recording of that. Yes, I think there are a lot of people in New Zealand, particularly in New Zealand policy world, who are kind of bemoaning what is Australia's advantage. Yeah. And look, I'll take every advantage we can. And New Zealand are welcome to become a state at any time. But I think there's a lot of New Zealand policy work being done to kind of try to retain young people. And I think that would be a good thing for their country. But until they figure that out, their loss is our advantage. I love my Kiwi friends, including you, Jessy Wu. Thank you so much for joining us.
Thanks for having me
on the podcast.
Thank you for listening to the Inflection Points podcast, a production of Inflection Points Publishing, including me, Jonathan O'Brien, as well as Ethan Gilbert and Manning Clifford. Our music is by Isha Ramdas, who also provides additional engineering support. Thank you for listening. We'll talk to you soon.